Oy vey, bond bubble collapse imminent. Get ready, folks. It's all about the bond market. It's about to discombobulate. Oy vey. But let's hold on a second. I actually discussed the 10-year Treasury note in relation with the bond market. So let's take a look at it. What's going on, you guys? So let's take a look at it. So let's pose the question, because it's easier to understand. What is the current bond market sentiment? Remember, I talked about this in my previous video. The current sentiment in the bond market seems to be leaning towards bearishness. The 10-year Treasury yield has recently breached 5% for the first time since 2007. This increase in yield is due to the combination of factors including Federal Reserve interest rate hikes, swelling supply, and the view that the Federal Reserve will keep its policy rate elevated indefinitely. Oy vey, you guys. Oy vey. Investors are starting to question whether the economy can withstand current interest rates. The outstanding debt is estimated to increase by 1.5 trillion to 2 trillion in 2024 versus about 1 trillion this year. That's really a discombobulation. The rise in yields translates into higher borrowing costs for households, businesses, and governments in the U.S. and abroad. Folks, do you understand what we are involved in here? It breached 5% since 2007. That's bigly. And we know what happened after 2007, right? We had the discombobulation of what, 2008? Oy vey, you guys! The Fear and Greed Index from CNN suggests that when the S&P 500 is above its moving average of the prior 125 trading days, it's a sign of positive momentum. But if the index is below this average, it shows investors are getting skittish. Oy vey, you guys. You understand what we're involved in here? Oy vey, Let's continue. In summary, the bond market sentiment is currently bearish, with rising yields and increasing concerns about the economy's ability to handle current interest rates. Oy vey. So let's pose a question. Let's ask, what does it mean when the 10-year Treasury reaches 5%? It's discombobulating. It's discombobulating. It's discombobulating. Discombobulating. It's discombobulating. Guys, I'm getting scared. I think it's discombobulating. Once something is breached, it's over, Johnny. It's over, Johnny. I'm telling you guys, it's discombobulated. It's discombobulating. Oh my God, look at all this reading we have to do just to find out what it means to be breached. Oy vey, you guys. Are you guys getting scared? Let's read this. Oy vey, this is complicated, you guys. So I'm gonna let it, read it for us, because it's discombobulated. Play the clip, Johnny.
When the 10-year Treasury yield breaches 5%, it means that the annual interest rate that investors will receive if they buy a 10-year Treasury bond is 5%. This is the highest level since 2007. and it reflects several factors, such as rising inflation expectations. Investors demand higher yields to compensate for the erosion of their purchasing power by inflation. The Consumer Price Index, CPI, rose 6.2% year-over-year in September, the highest since 1990. Tightening monetary policy. The Federal Reserve has been raising its policy rate, which influences short-term interest rates, to combat inflation and cool down the economy. The Fed has hiked its rate 4 times in 2023, from 1.25% to 2.25%. Increasing fiscal deficit. The U.S. government has been borrowing more to finance its spending programs, such as infrastructure and social welfare. This increases the supply of Treasury bonds in the market, which lowers their prices and raises their yields. The fiscal deficit is projected to reach $3.4 trillion in 2024, or 13.4% of GDP. A higher 10-year Treasury yield has implications for the economy and the financial markets, such as higher borrowing costs. The 10-year Treasury yield is a benchmark for many other interest rates, such as mortgages, corporate bonds, and student loans. A higher yield means that borrowers have to pay more to access credit, which can dampen consumer spending and business investment. Lower bond prices. Bond prices and yields move in opposite directions, so a higher yield means that existing bondholders will see their bond values decline. This can reduce their wealth and income, and also affect their portfolio allocation decisions. Lower stock valuations. A higher yield can also affect the stock market, as it makes bonds more attractive relative to stocks. It also increases the discount rate used to value future cash flows of companies, which lowers their stock prices. A higher yield can also signal a slower economic growth or a higher risk of recession, which can hurt corporate earnings and investor sentiment.
Folks, are you getting scared? Are you getting scared? Let's ask another question. Does this mean bondholders will sell their bonds and reallocate their earnings into stocks? Meaning, where are they going to put their money if they're getting discombobulated, thinking about the discombobulation? Does this make any sense? It is not possible to say for sure what bondholders will do, as different investors may have different strategies and preferences. However, some possible scenarios are. Oh my God, my friends, this is like the big enchilada right now. What are some of their possible scenarios? What are the possible scenarios for bondholders? Sell bonds and buy stocks. Some bondholders may sell their bonds and reallocate their earnings into stocks. If they expect the stock market to perform better than the bond market, they may also seek higher returns from stocks, as bond yields are still low by historical standards. Or they smear you guys. Let's continue. Hold bonds and wait. Some bondholders may hold their bonds and wait for the yields to stabilize or decline. If they expect the economy to slow down or the Fed to ease its monetary policy, they may also value the safety and stability of bonds, as stocks are more volatile and risky. Or they smear you guys. Are you getting all of this? Are you guys getting scared? Sell bonds and buy other assets. Some bondholders may sell their bonds and buy other assets such as gold, commodities, real estate, or foreign currencies if they want to diversify their portfolio or hedge against inflation or currency depreciation. They may also look for alternative sources of income or growth. Or they smear you guys. Oy vey smear you guys. Alright, my friends. So, yeah. Leave some comments. Tell me what you think. What are your thoughts? What are your views? Are you worried? Are you scared? Are you ready to fly soon? Tell me what you think, because I got to know. Keep stacking. Catch you on the other side.